Today's lecture is for chapter 11 and for reporting for control. So since we find out what kind of costs we have in the company, since we find out what's the relationship between the cost, the volume, and profit, and since we did that analysis, since we talk about the job costing and how we price our product, in the manufacturing company and in the service company, since we find out how to deal with the activity-based costing and how to use the activity-based costing to allocate manufacturing overhead to our product more appropriate. Then we did the budget. For the budget control, we use variance analysis by using the flexible budget. Now we're going to see how we can report for control. First, we're going to start. In order to create that report, we have to prepare, they have to see what kind of organization we have in the company. There are two types of main organizations. One is centralized and the other one is decentralized. Both have their benefits and both they have drawbacks. We're going to start first with the benefits of the decentralization system in organization. A centralized system obviously is understandable. That will be one person who controls the whole process in organization. Where decentralized system in organization will give more power to the management. Why we want to do that? Because if we give more power to the lower level management, they're going to have more experience in decision making. Also, giving them that decision making experience, that's going to create a more just satisfaction in those lower level management. Also, we can rely that lower level management going to have more information to make decisions since they have a better information and they quickly can respond to the customers since they're the one who's dealing with the customers. So the benefit is giving them more power and authority in decision making to the lower level management. That's going to give the top level management more time to think about the strategy of the company and focus on the strategy. Again, everything that has benefits has disadvantages. In this case, one of the main disadvantages that the lower level management, even though they can make decisions, they might not be able to see the big picture. There might be also lack of coordination between the managers in different departments in the company. Because sometimes when the system is decentralized, there's no communication among the managers. The other disadvantage is the low-level managers' objective may not be those of the company. It's very important for you as a manager to clearly think and identify which are the objectives of the people that you're responsible for. What that means is the low-level management, you have to understand their motivation and their objectives are different than those of the organization. We already established that each of us is more concerned of his personal objectives rather than the company's objectives. So for that reason, have it in mind when you work in decentralized system, which is mostly everywhere. And you on the management position and you have people who are responsible to. The other drawbacks for that decentralized system is it will be very difficult to spread innovative ideas into organizations having in mind that the low-level management objectives against are not the one of the organization. That brings her to other main point, how are we going to make a report? Well, obviously, when we're dealing with a decentralized system, reading the final financial reports of the company is not going to be very helpful. The one that are publicly available on the stock exchange or somewhere on the electronic documents which are available for the readers of the financial statements. Those financial statements will be very um, general, first, and second, there will be the statements for the entire organization, both for the management purposes in order we to be more effective and make decisions. We don't need the final financial reports of the company. Then the question is what we really need. Well, we need and to see costs, revenue, and profit data for the activity that we can control as a managers. So for that reason, we're going to prepare a segment report, which will be part of the main report, but it's going to include only either individual store or individual department or individual sales territory or service center, or you can even go with the particular product or particular client. That's going to give us more idea how we can improve and what we can improve in the small picture in order to get benefits in the big picture of the company. Now, there are two key when we're preparing this segment income report statement. First, we have to use the contribution format. Why? Because we want to separate the fixed cost from the variable cost in order to be able to see how much is the contribution to a certain department or certain product into the overall profit of the company. Second thing is we have to separate traceable fixed cost from the common fixed cost. In order to do that, first we have to understand what's a traceable fixed cost and what's a common fixed cost. So the traceable fixed cost, they come or arise because of the existence of particular product or particular segment or particular client. If we eliminate that client, that or that product, that cost disappears. So that will be traceable cost. Example for the traceable cost will be the cost of the gas. So if you buy a car, you have to pay for the gas. If you eliminate the car and sell the car, you don't have to pay for the gas anymore. Same thing with the car insurance. If you have a car, you have to pay car insurance, which is traceable cost to the car. If you eliminate the car and you sell the car, you don't have to pay that insurance anymore. Common cost happen because of the overall operation of the company. And they will not disappear if we eliminate specific segment or specific product or specific client. Example will be, um, let's say, for the household, that will be the grocery. If you have a car and you eliminate the car, you still have to pay for the grocery. If you have a car and you have to pay for the gas of the gas of the car will be gas for the car, that will be traceable cost. but the grocery will be common cost for the household. So eliminating the car, that doesn't mean that you can eliminate the grocery cost. We're going to give you more example with the common cost and traceable cost so you can understand it better. Now, for the reporting purposes, somehow we have to find a way to allocate the cost to the products. One common way to allocate the cost to the product will be based on the activity that cost is used by our products. Example for this allocation will be if we have three products, which is 9-inch, 12-inch, and 18 inches pipe, and all those pipes are located in the single warehouse, and the cost for the renting the warehouse is $4 per square foot. So that's equal to $40,000. Now the question is, how can we allocate those $40,000 to the three products that we have in that warehouse? Well, one way to use it is proportional method, and for that reason we have to find a proper allocation base. In this case, the proper allocation base will be the square feet of space that each product occupies. And as you can see, the 9-inch pipe, they occupy 1,000 square feet. 12 inches, they occupy 4,000 square feet. And 18 inches pipe, they occupy 5,000 feet. Since the total is 10,000, we can easily get a percentage of occupation for each product, and which can allocate the $40,000, or we can use the square feet and the cost per square feet to allocate the cost of the rent. Either way works, and in both ways we're going to get exactly the same result. That's how we're going to allocate 4,000 to the first product, which is 9 inches. Then we're going to allocate $16,000 of the rent to the second product, 12 inches, and we're going to allocate the $20,000 to the third product of 18 inches. This is just a simple ideas how we can allocate the cost in order to prepare reports for control purposes. Now, on the traceable cost, we already established that the traceable cost is the cost that can be directly traced to department or to the client or to the activity. It's important for us to realize that the traceable cost in one segment might be or may be a common cost for the other segment. For example, every plane has to land. In order to land, they have to pay a landing fee. So we pay a landing fee per airplane, not per number of seats, not based on the different seats that we provide in the airplane, for example, business class, first class, economy class. So what that means is the landing fee is a common cost for the entire plane. Also, we can say that the traceable cost to the plane or the common cost for every single of the seats that we have. They're not traceable cost to the first class, business class, and economy class. Why? Because if we have in the airplane business class, plane has to land. So if we allocate landing fee to the business class, and one day we decide, hey, business class, we don't want to provide anymore business class. Let's move on to the first class and economy class. Then we still have to land the airplane. So elimination of the business class is not going to eliminate the landing fee. So for that reason, it doesn't make sense to allocate the landing fee for the business classes in order to make our decision should they eliminate the business class or not. For that reason, please be careful when you're allocating common cost. And the general rule is you're not allocating common cost to the segment or to the client or to a division. How are we going to prepare that segment margin? Segment margin will be simply computed by subtracting traceable fixed cost of the segment from that segment contribution margin. And that's how we're going to get the segment margin. That's going to give us the best idea how that particular segment perform on the long run and is that profitable or not. Now let's go with the example in order to see how this is applied with the common cost and traceable cost and how we're going to come up with the segment margin. We're going to use this company that have a two division. One division is computer division, the other one is the television division. And let's look closely on the television division income statement. If you take a close look, we're gonna see that television division have sales of $300,000, variable cost of goods sold, and variable other costs in total 150, and that's give that division $150,000 contribution margin. Then after that we have the traceable fixed cost, and at the end we achieving a $16,000 divisional margin. Once we have this report, we can see the entire company report. Again, the television division contributes to the company $60,000. But we have computer division that contribute to the company $40,000. That's in total give us $100,000 division margin of our two division, television and computer. The common costs, after that we have a common cost which are common only and only to the company. And then we have the net income for the company, $75,000. So what will be that $25,000 common cost for the entire company? That will be accounting. That will be more like a CFO salary. That will be more likely something which is a common cost for the entire company, not something traceable to television or computer divisions. So that means that if we eliminate the computer division, those $25,000 common cost will not gonna change. Now, as we already established, fixed costs that are traceable to one segment can become common cost if we go on the smaller segment report. Let's see example for that. And let's work with the same company example that we have in the previous slides. Let's take a look at the television division and let's go deeper in television division and see from where that 60,000, if you remember, television division generates 60,000 divisional margin, where the 60,000 divisional margin comes from. Well, those two divisions, regular and big screen, have their product line margin. The regular television product line margin is $60,000. $300,000 sales, variable cost 95, and then we have a traceable fixed cost. Then we have the big screen, which have sales 100, variable cost 55, give us contribution margin 45,000, minus the traceable fixed cost for that particular segment, and we have 10,000 product line division. Combined on direct way and liquid generating $70,000. But hold on a second, our divisional margin is 60. Well, what that means? That means we have more costs which are common. So the $70,000 product line margin is before allocating the common cost for the television division, which will be purely probably the cost of the manager of the television division. So what that means? That means is if we eliminate the big screen, those $10,000 common cost still gonna stay with the television division. Now, how are we gonna deal with this segment reporting for accounting purposes? For those of you who are gonna continue with the accounting, there's International Financial Reporting Standard 8, which is dealing with the segment reporting of the operating segment. So those of you who's going to continue with accounting, they have to deal with that International Financial Reporting Standards. Which are the problems of the allocating the cost? One of the problem is to skip some of the costs when we start assigning process for the costs. We might forget some cost, or we might miss some costs. So for that reason, we have to be very careful when we prepare those segment reports. Second, we might assign the common cost to the segment, which in fact shouldn't be assigned. Which means that if we do that, then we can change the picture of that particular segment. And then we might use an appropriate method to allocate the cost between the segments. What's going to happen if we forget some of the cost? Obviously, all the cost of the segment should be included. And how we're going to include those costs based on the value chain of the company. As we established before, the value chain of the company is starts with the research development, product design, manufacturing, marketing, then distribution, and final is the customer service. If you take a close look, and if you think a little bit, all those stages, research development, product design, manufacturing, marketing, distribution, customer service, all of those stages is cost generating. But only one of these stages is producing profit as well. And that's not research development, that's not product design, that's not the marketing, that's not the distribution, that's not customer service. Those are support activity to one main activity, which is manufacturing. Only manufacturing activity generating something that can be sold. So all the sales are heavily dependable on the manufacturing. So during the manufacturing process, if we don't generate enough sales to cover research and development, product design, marketing, distribution, customer service, we have a problem. Which is those inappropriate methods of allocating the cost among the segments. First inappropriate method is many companies do not correctly handle the traceable fixed expenses. So what they're doing is they mismatch the traceable fixed expenses, or they may simply allocate the common cost and treat them as a traceable expenses. First, they may not trace the fixed expense of the segment, even though it's feasible to do so. And second, they might be inappropriate allocating base, use the inappropriate allocation base for those traceable fixed expenses. So those are the two scenarios in which shows the incorrect allocation of traceable fixed cost. And the last one is the allocating common cost in the segment. The common cost should not be just allocated to the segment based on the rationale that somebody has to cover the cost. And for that, we can use those two reasons. First is that the practice can make a profitable product or profitable client look unprofitable. And allocating the common cost makes the managers to be responsible for the cost that they cannot control. Example will be this uh, company which has two divisions. They have bar and they have a restaurant. Now let's see what's the overall report of the company. The company reports sales of $800,000. Of those one, they have 310 variable cost, 246 traceable fixed costs, and 200 common fixed costs. So from the 490,000 contribution margin, after that they have to deduct 446,000 common cost, fixed costs, sorry, and they can come up with the profit 44,000. Now those 244 segment margin comes from the two divisions or two segments that they have. One is a bar and the other one is the restaurant. Bar generates sales $100,000, variable cost 60,000, contribution margin 40, and they have a traceable cost $26,000. That means that if we eliminate this bar, if you eliminate the bar, those 26,000 will disappear. For the restaurant generates sales of 700,000 with 250 variable cost. That gives us $150,000 contribution margin. Then we have a traceable fixed cost for the restaurant, 220,000, and the segment margin from the restaurants only $230,000. After that, we have those common costs, which are common only and only because the company exists, not because of the bar and restaurant. Is because of the company. That will be the CFO salary, that will be accounting salary, that will be some other salaries which are related only to the company. So that means eliminating the either bar or restaurant, that's not going to affect those $200,000. We still want to pay the $200,000. So now the question is, how much of the common fixed cost can be avoided if we eliminate the bar? What do you think? Obviously, nothing will be eliminated. Why? Because those are common costs. So dropping the bar is not going to affect the common costs. Now, let's think about something. If we decide to use the square feet as a basis to allocate those $200,000, Even we shouldn't be allocating those ones, but let's say somebody decide to allocate because somebody has to pay for the cost, and we find out that bar occupies 100,000 square feet and the restaurant occupies 900,000 square feet. How much of those $300,000 will be allocated to the bar? Obviously, simple calculation will be 1,000 square feet for the bar plus 9,000 square feet for the restaurant, total is $10,000. 1,000 out of 10, that's 20, and that's 10% of the total square feet belongs to the bar. 10% of $200,000, that would be $20,000. So we are going to allocate $20,000 to the bar if we have to allocate it. So we're allocating $20,000. Now, if they do allocation common costs to the bar and the restaurant, what will be reported profit for each segment? Well, let's think about it. If we're allocating 10% of those $200,000 here, that will be 20,000, and the rest 180 here, bar automatically is going to show negative or loss of $6,000. And the restaurant is going to show that will be 180, there's going to show $50,000 profit. The question is that true? So again, the restaurant going to show 50,000 and the bar is going to show 6,000. Now the question is, shall we eliminate the bar? Well, the answer is, how much of those, if we eliminate the bar, since looks like we're losing $6,000, how much of those $20,000 we can save? And since the answer is 0, the normal response will be, don't eliminate the bar. Because if you eliminate the bar, those $20,000 going to move to the restaurant. And that restaurant, instead of $50,000, is going to generate profit of only $30,000. So if you want to lose $20,000, yes, please eliminate the bar. But if you want to save $20,000 loss, don't eliminate the bar. So decision here for the eliminating bar, should I eliminate some division or not, is only you eliminating division only and only if the overall profit after elimination improves. If the overall profit decrease, don't eliminate. That brings us to responsibility centers. In the big organization, we're going to try to break that organization into different responsibility centers. Why? Because we have to keep the process of control intact. For that reason, we're going to have centers based on the different level of control. And those will be accountable either for cost, either for profit, either for the investment. The center that is accountable for cost, that will be called cost center. The segment that's going to be accountable for the profit, that's going to be profit center. And the center that's going to be responsible for the investment in investment only, that's going to be called investment centers. The cost centers, again, is a segment where the manager has control over the cost, not over the revenue or investment funds. Where the profit center, the segment, that segment manager, it has control over the revenue and the cost, and indirectly to the profit. The investment center is the last center, and those managers are responsible and they have control over the cost, revenue, and investment of the operating assets. So those managers, let's see in the big organization, which centers where it's going to be, the cost center will be in the very, very, very lower level. Those will be managers of different products or managers of different warehouse, some divisional managers. Profit centers managers, those who have managers which are on some kind of complete process, which including selling and production. Where the investment centers, that will be the headquarters of the company, where the key people combining all the information from the cost, from the profit centers, and now they can operate with the excess of money or make a decision from where the company should borrow money. Now, how are we going to evaluate these investment centers? The investment centers, it's very easy. We're going to evaluate them on return on investments. The question is, if you invest $100,000, how much return did you get from those $100,000 or $10,000? Return on investment, it's very easily calculated because it's a simple calculation between operating income as a nominator, which may be income before interest and taxes, and the average operating assets, which assets including cash, accounts receivable, inventory, plant equipment, and other productive assets. Key word here is average. The question is how we're going to get the average. Well, average operating assets, we're going to get it as an asset at the beginning of the year plus the asset at the end of the year divided by 2. And that's going to give you that average operating assets that you have during the reporting period. Now the question is how much return you have generated from those assets. Another example will be if you invest $10,000 for 1 year for GIC, which is Guaranteed Investment Funds certificates, and they promise to give you 10%. So investing 10,000 and 10% return. How much do you expect to get? Or if at the end of the year you find out that you have $1,000, how much is your return? Well, obviously, if you get only $1,000, that means you already lost 9. So that's not the proper question. The actual question is if you invest $10,000 and at the end of the period, at the end of the year, you open your bank account, you actually have $11,000. How much is your return on investment? Well, obviously, you get to return $1,000, which is 11,000 minus 10,000, $1,000, and then 1,000 divided by the original investment, which is 10,000. It's going to give you 10% return. So how are you going to get the return? Simply dividing operating income using as a numerator, average operating assets as a denominator, and you're coming up with the calculation for return on investment. Since we're using assets, we're coming to the point, what's cost of those assets we should use? Shall we use the net book value, which is simply the original cost minus the cumulative depreciation, or we should use the gross cost, which is the original purchase price? There are a lot of debates about this, which one to use. And at the end of the day, the people decide to use net book value. How are we going to get the net book value? Original cost or acquisition cost minus the accumulated amortization or depreciation for the asset. It's going to give us the net book value of the asset. And we're going to use that value to calculate the return on investment. Now, before I move to the second formula, I want to open one Excel spreadsheet. And I'm going to show you something on the Excel spreadsheet so you can actually understand it. It's very simple. It's like more like a playing with the formulas rather than giving you something new. But in order to see that game, I want to use the Excel spreadsheet so you can understand clearly what exactly happened. Now let me share my screen. So we already established that if you have investment of, let's say, 10,000, and after 1 year you have balance of 11,000. That means you're generating 1,000 profit. $11,000 at the end minus 10,000 at the beginning, you generate a profit of $1,000. Now the question is how much is your return on investment? It's on investment, and in this case, the return on investment it will be equal to 1,000 divided by original investment 10,000, and that's going to give you asset percentage. It's going to give you 10% return on investment. Now, so how we get the return on investment? The return on investment is equal to profit or net operating income, let's put it this way, divided by average operating assets. Now, at this point, we're going to use the game and playing with the formulas. First thing first, let me see if I can get this formulas more appropriate. That's not going to be the one, but no, I don't think I can be able to do this. Anyhow, let's forget about this. And let's use the Excel as much as I can. Return on investment, again, is equal to, then here we're going to have, we get those two like this. We do some changes here, and then you can see it. Try to use the Excel as much as you can so I can, it's going to give you, that's how we use it. That will be operating income divided by average operating asset. That will be our formula. Now the question is, if I use this simple trick, time If I multiply this formula by 1, am I changing the formula? An obvious answer will be no, we're not changing the formula. If we have exactly the same formula. Well, but in that case, that 1, we can say 1 is equal to cells divided by cells. And if I do this trick, and substitute in this formula, then I'm going to have a new formula, which will be, I'm going to copy this here. And here I'm going to have cells divided by cells. Now I have completely different formulas. Now I have that the return on investment should be equal to the operating income divided by the average operating assets times cells divided by cells. And now I can make some combinations. What will be my combination here? My combination will be average operating income divided by cells and cells divided by average operating assets. Now, since I have this, I can easily see that average operating income, operating income divided by cells, that it's purely equal to margin or operating margin where in other formula, in other part, which will be here, that will be here, where we have cells divided by average operating assets, that's going to be equal to turnover. So once we know that, we can easily substitute in this formula, actually in this formula, sorry, and we can say that return on investment now is not equal to the operating income divided by sales, but it will be equal simply to the margin time turnover. And that's how we get to the point that we have those two, margin and turnover, and now we can start playing with the margin and the turnover. So let me stop sharing this and go back to the slides and see how the slides continue at this point. So since we established that we're using the net book value for the average operating assets, then we're going to have that return on investment is equal to operating income divided by the average operating assets. And since once we do the trick with the cells divided by cells, then we're going to have a new formula, which is return on investment is equal to the margin times the turnover. Margin will be operating income divided by sales, where the turnover is sales divided by average operating assets. Now the question is there anything we can do to improve the return on investment? And the answer is yes, there is something that we can do to improve our return on investment. We can increase the sales, and that's going to change return on investment, or we can reduce the operating expenses, that's going to change our return on investment, or we can reduce the operating assets, which also is going to change our return on investments. In order to understand return on investment and how can we affect the return on investment, we have to understand how the return on investment is calculated. Again, the return on investment comes from the margin times the turnover. So in order to change return on investment, we have to improve the margin. How The question is, how can we improve the margin? By knowing from where the margin comes from. And the margin comes from operating income divided by sales. So if we increase our operating income, since the operating income is our nominator, that's going to increase our margin. So how can we increase the operating income? Sales. Either by increasing the sales, either by reducing the expenses. Which expense we can reduce? We can reduce the cost of goods sold, or we can reduce the selling expense, or we can reduce the administrative expenses. And that's how we can improve that margin, which is going to affect our return on investment. The second option that we have is to improve our turnover. How can we improve the turnover? Well, either by increasing sales, either by reducing the average operating assets. Why reducing those ones? Because those are our denominator. So reduction in the denominator is going to show improvement in the turnover on the final result. How can we do that? By knowing what's in the operating assets. What's the operating assets? We have a current assets and we have a non-current assets. Which are current assets? We have cash, we have accounts receivables, we have inventories, we may have prepaid expenses. Any reduction of those assets is gonna improve we're gonna reduce the average operating assets. Since we reduce the average operating assets, that's gonna increase the turnover. Why? Because again, assets are our denominator. Decreasing the denominator is going to improve the turnover. That's going to improve return on investment. Let's see this one in example. This is the company that we have to deal with. I'm going to copy this information and I'm going to move it to Excel spreadsheet. And since we have the formulas in the Excel spreadsheet, I can easily use it. So let's see what we can get from this information. This is the information that we need. The calculation of the return on investment. Let's label it here, return on investment formula. And let's go with the next one, return on investment example. Not here. Sorry, that should be on the name. So let's go one back, and that would be right here. Return on investment example. So our example dealing with the following information. I don't need this, so I can easily delete this information here. In our example, we have the following. We have this company that have the following. They have operating income of $30,000. They have average operating assets $200,000. They have sales of $500,000 and operating expenses $470,000. So obviously we're going to use this formula. And if I paste it right here, we can easily see that our operating income is $30,000. Then we have average sales of $500,000. Then we have, let's make it like numbers. Then we have sales again, 500,000. And we have average operating assets of $200,000. So once I have this information, I can see, sorry, not that one, it's too much. That will be this one. Once I have this information, now I can start working on my calculation. How much my return on investment? And for that reason, I'm going to use this formula here. Return on investment is equal to this one divided by that one, and that will give us a percentage. And the turnover is equal to this one divided by that one, which will be a simple number. So for that reason, our return on investment is equal to 6% times 2.5. Or we're getting a return on investment of 15%, as you can see. And this is where we are with this company at this stage. We're generating a return on investment of 15%. Once we calculate it, again, we're using the same formula, margin time turnover, which margin is equal to operating income divided by sales. Turnover is equal to sales divided by the average operating assets. That's going to generate 50% return on investment. Now, making 50% return on investment, that's boring. So let's see, is there anything that we can do in order to change that return on investment? First thing what they did is they were able to increase the sales to $600,000, while the operating expenses increased to 558. Operating income increased to 42,000, obviously, and there's no changes in average operating assets. So let's get this information and go to our Excel spreadsheet and see what's going to happen once we implement those changes. So this is our initial calculation. After that, what we're doing is this one. I want to copy this picture, slides, paste it there as a picture, which is going to be this. So what's happened is operating income instead of 30 become 42,000, where the sales jump to 600,000. Now that 600,000 is going to come here, 600,000, and there's no change in average operating assets. And so what we did, we by doing those things, we increase our return on investment from 15% to 21%. How? By increasing sales, which help us to increase our operating income. That's the first scenario. Let's see what's the second scenario. Before that, let's go to the slides again and see the slides. So they show us exactly the same calculation that we saw. So our return on investment improved from 15 to 21%. Next scenario, this company manager decides I was able to reduce the operating expenses by $10,000. Only the operating expenses. Let's do the copy and go to the Excel spreadsheet and see how we can use the Excel spreadsheet and what calculation we can make there. Let's post this information as a picture and start working with it. Again, we're assuming now the company, the only thing that they're doing is they're reducing operating expenses by $10,000. That's all. Nothing more, nothing less. So if they reduce from the original stage, if they reduce the operating expenses with $10,000, that's going to increase operating income, correct? So that now the new operating income will be 40,000. Sales, no change in the sales, and no change in the average operating assets. So by only decreasing expenses with $10,000, we were able to change our margin and improved our margin from 6 to 7%. Sorry, that's not incorrect because our sales are 500,000. There is no change in the original stage with the 500,000. So, since the sales stay in the 500,000 and we reduce the expenses with $10,000, that our profit jumped with $10,000, and that increased our margin from 6 to 8%. There's no change in the turnover, which is exactly the same, 0.5, but our return on investment now increased from 15 to 20%. That's another way to improve our return on investment. Simply reduce the expenses. Let's go back to the slides and continue the slides and see what's the next scenario waiting for us. So, once we do the same calculation, the one that we see in the Excel spreadsheet, we improve the return on investment to 20% from 15 become 20. Next scenario. Manager was able to reduce the inventory by $20,000 by using just in-time technique. Nothing else is affected. So let's copy this information here and let's move it to our Excel spreadsheet and use the Excel spreadsheet to see what exactly happened in this scenario. This is our scenario, this is our calculation. Let's copy this one and see where we are in this case. So our operating income stayed the same. Original stage $30,000. Sales are original stage. The only thing that we improve is the average operating assets reduction with 20,000 to 180,000. That trigger increase in the turnover. And since the turnover has increased, our return on investment also increased to 16.7% from 15% originally. Let's change the numbers of the decimals here. So we move to 16.67. So 1.67% increase in our return on investment only and only by reducing our average operating assets. Okay, let's move back to the slides. Again, by doing this, we improve the return on investment from 15 to 16.7%. Next scenario, manager invested $30,000 in the new equipment, which increased the sales by 35. Also increased the operating expenses by 50. So that's our new information. Let's copy it and move back to the Excel spreadsheet and use this information for our calculation purposes. So in this case, operating income is $50,000. Sales 535,000. Again, sales 535 here. And the average operating assets also increased to 330,000. Now, what's happened here is margin increase, the turnover decreased from the original stage from 2.5 original, went down to 2.33. But the increase in the margin bring the return on investment to 21.74%. Let's go back to slides and check the slides. So yes, our return on investment increased to 21.8% out from the 50. By simply investing more money and those are all the scenarios. So you can see just increasing the sales, reducing the expenses, reducing the average operating assets, we're able to improve our return on investment. Now, which are there are always critiques against everything. So, which are critiques against return on investment? First is that if we don't have the balanced scorecard, we might not know how to increase the return on investment. Or managers always have costs, which are committed costs. Remember, when we talk about the fixed costs, we have a discretional and committed cost. Committed is the one that the managers can do anything about. It means that they cannot change it because they're already commitment on the long term. And the last thing is the managers which are evaluated on the return on investment, they might reject profitable investment opportunities. So for that reason, we're gonna come up with a new measurement, and that will be our residual income. Residual income will be the operating income above some minimum return of operating assets. So in order to explain this, I'm going to go back to the Excel spreadsheet and I'm going to show you the original scenario that we had with the investment of $10,000. Let's click this one and we call it a residual income here in this case. The residual income is very simple. Again, like a turnover, but let's delete those one. It doesn't have to interfere with us. So imagine again, you have investment $10,000. Your return on investment is 10%. So in this case, you're expecting profit. This information is changed, so we have to flip the information. Right? So return on investment is already given to you. So basically, you know how much you expect as a return on investment, and you're expecting 10%. So that means that at the end of the period, you expect to have a profit of $1,000, or 10,000 times 10%. That's how much I expect. Now, my actual profit at the end of the year is not $1,000. It's actually $12,000. Sorry, $1,300. I'm checking my bank account. I have 1,200 actually in my bank account. I have balance of 11,200. Expecting 11,000, 10,000 plus 1,000 profit, but I have in my bank 11,200. So my actual profit is 1,200. So for that reason, residual income in this case is equal to actual return or actual profit minus expected, which expected in this case is equal to investment or average operating assets time required rate of return in this case. So that's not going to be a return on investment, that's going to be a required rate of return. How much company expect. So in this case, return on investment, residual income, is going to be the actual profit, which is 1,200 minus $10,000 times 10%. Or in this case, the return on investment, residual income is equal to $200. That's how we're calculating residual income. Now let's go back to slides and see what the slides are going to tell us. Again, residual income is the operating income, which is actual, minus the average operating assets time minimum required rate of return. This computation that still obviously is different than return on investment, and measure the return on investment when the return on investment measures the operating income earned relative to, the investment. Residual income measures the operating income less the minimum required rate of return. So let's see this example. This company has average operating assets of 100,000 with the required rate of return of 20%. During the period, the division earned $30,000. What's the residual income? Let's stop this slides and let's move to the Excel spreadsheet so we can see if we can calculate this. That will be the example here. That's our question. And let's see how we're going to use this question. So they have average operating assets, or our investment, average operating assets, are equal to $100,000. They're expecting 20% return. So they're expecting $20,000 profit. At the end of the period, the actual profit was 30,000. The question is, how much is the residual income? Yes, as you can see, the residual income in this case is $10,000. Why? Because they're expecting to get 20,000, but in reality they get 30,000 or $10,000 more. Let's see the slides and see how the slides continue at this point. So again, we have the operating assets of 100,000. We required 20%. That means we expect to get 20,000, but in reality we get 30,000. That's going to give us a residual income of $10,000. So what will be the motivation here, and what's the difference between the residual income and return on investment? Residual income encourages manager to make a profitable investments when that project, that investment might be rejected if the manager is using the return on investment. So let's see the example, which is this company is a division of the Wrap-Up Corporation, has operating income of 60, so an average operating asset of 300. Required rate of return for the company is 15%. What's the division return on investment? Well, we're simply going to calculate the return on investment by operating income divided by the average operating assets, which we already know the formula. So once we apply that one, we can easily see that our division return on investment, it will be equal to 60,000 divided by 300,000, or 20%. So this is our division return on investment. Now, this company manager If the manager is evaluated based on the return on investment, which as we calculated was 20%, and if that manager wants to invest $100,000, that will generate 18% operating income per year. If we're using as a point of evaluation those 18%, those, sorry, I lost it, so 20%, the question is this manager going to actually invest? Now, as we simply can see that 18,000 operating income out of 100,000, that's 18%. And if this manager is evaluated based on current return on investment, which is 20%, the manager simply is not going to invest in that project. Why? Because it's going to reduce the return on investment on that particular division. So even if we combine all the revenue or all the income, 18 plus 60, 78, divided by the total operating assets, we still cannot achieve 20% return on investment, which we originally have. So for that reason, the manager simply is not going to invest. Now, what if the company requires 15% return? Well, if the company requires 15% only, so for this one, let's use the Excel spreadsheet. In this case, if the company requires 15% and we have $100,000 to invest, the company actually requires only $15,000, but the project will generate 18,000. So in that case, do you think the manager is going to invest? Well, absolutely. In that case, the manager is going to invest. Why? Because the manager is going to generate $3,000 more than the company wants. Why? Because company only require $15,000. So then the next question is, again, the division has operating income of 60,000, average operating assets of 300. What's the division residual income? Now, in that case, we have to go back to the formula, to the Excel spreadsheet, and use that Excel spreadsheet. So let's post the question right here. And let's see what will be our calculation in this case. Or maybe I can just flip it on one additional of this question. We can bring this question here. So in this case, the company has average operating asset of $300,000. They require 15%, and then in reality they generating 60,000. How much is the residual income? Residual income is $15,000. Why? Because the company wants expect to have require 45,000. In reality, they get 60,000. So that means residual income is $15,000. And 50,000 is our answer. So now, if the manager of the company is evaluated based on the residual income, will the manager going to invest on the project which generates 15,000, 18,000 per year? Absolutely. Why? Because he's going to generate $3,000 more than the required rate of return of the company. So, as everything, this residual income, yes, it might be a little bit better than return on investment calculation, but this residual income have one major disadvantage. And that disadvantage is we cannot compare divisions from different sizes. What that means? That means if we have those two divisions, which one division have operating assets 100,000 and the other 1 million, they have required rate of return, both of them require rate of return is 20%. So that means a retailer we expect to get 20,000, from the wholesale we expect to say get 200,000. So far, so good. In reality, we getting from the retailer 30,000, where in the wholesale we get 230. So since we expect to get only 20,000 from the retailer gave us $10,000 residual income, where the warehouse we getting 220, but we expecting 200. So the warehouse give us 20,000 residual. If we ignore the size, we can easily say that, well, the warehouse is more preferable because the residual income is more. But if we count the size, and if we put the size of those divisions in the picture, then we have a problem. Why? Because retailer generate 30,000 out of 100, so they generating 30% return on investment. Where the warehouse out of 1 million generating only 220,000, which is 22% return on investment. So if we base down a decision on residual income, and if we decide to go with the wholesale, we're going to make a mistake. For that reason, we cannot use residual income when we're comparing projects on the different sizes. Again, we cannot compare performance division of different sizes. Why? Again, because this retailer generates return on investment of 30% compared to the 22% of the wholesale. The other critiques against the residual income is that the residual income based on the historical accounting data. Also, residual income does not indicate what earnings should be. Calculating the residual income has dealing with a lot of adjustments, and residual income does not incorporate important leading non-financial indicators. Which will be that non-financial indicators, and we're going to come to this right now. That will be the balance scorecard. Balance scorecard is used for evaluation purposes. Simply, the balance scorecard helps the management to translate the company strategy into performance measures that employee or everybody in the company can understand and accept. It has four perspectives: financial, customers, internal business process, and learning and growth perspective. Balance scorecard is one of the most important tools for evaluating the performance of the employees. Now, obviously, the balance scorecard has financial and non-financial measures. Let's make it a little bigger. How we can interpret the balance scorecard? Every company has a mission and vision. To the financial, we're going to see what's our financial goal. What do we want? What do we want to have? To the customer perspective, we're going to see what the customer wants. How can we serve our customer better, having in mind our mission and vision? And the internal business process, it will be what's internal process is crucial to our customers, providing the value for them. Now, on the balance scorecard, I want you to understand first the business. The business is the whole idea of doing business is you to create the value for the customers so they can pay you form of money. Yes, you open your company to generate profit, but in order to generate profit, you have to create a value. Value to whom? Value to your customers. So you have to find the product which your customers want, and that product brings the value to your customers. Otherwise, no one's going to pay you the money that you want or the income that you want to generate. So, yes, financial perspective is important in order to see where you are, how much you're generating, from where you're generating your income. But the most important perspective here is customers. Customers, what the customer wants. Do the customer recognize the value that you're generating for them? Do the customers need that value? Which customers you're targeting? Are you achieving your objectives? So once you know those things about the customers, then you can focus on the improving the internal process in order to generate or to bring value to your customers. Once you bring value to your customers, customer satisfaction is going to increase. Once the customer satisfaction increase, you're going to improve your financial. Now, in order to improve the internal process, you have to go back, all the way back to the beginning and start learning and start growing. Learning not always is equal to growth. We have so many examples when the people learning and after that there's no growth. So in order to grow, you have to implement what you learn into improvement by internal in your internal process. That way and only that way you're gonna create value to your customers, which they're gonna appreciate and gonna come back, and that's gonna appreciation is gonna come back to you in terms of financial. How else you can interpret this balance scorecard? If you for a second close your eyes and think about it, in your personal life, at work, sorry, in your professional life, let's go with professional life, let's forget about for a second, personal, professional life. We are working. Who is our customer? So our customer is the employer. So on the balance scorecard, everything starts with the financial perspective first. So what's happened here? You open your bank account and you're checking the on Friday or 15th. You're checking your bank account. Once you check your bank account, you have two options. Option one, you like what you see. Option two, you don't like what you see. If you don't like what you see, what that means? That means that your customer might not be happy. Again, who is your customer? Your customer in this case is employer. So what you have to do? You have to learn about your customer. You have to learn what the customer wants, what the customer needs, what value you have to create for your customer in order to make your customer happy. Only and only when you create value for your customer, you're going to see improvement in the financial perspective or in the balance in your bank account. But how can we make a customer happy? By learning about the customers, what they want, what they need, for what they're willing to pay more money. Once you do that, once you understand the customer needs, then you can start changing the internal process by creating a process which is going to bring more value to your customers. Now, how can you change internal process? Well, go back to learning growth, which exactly where you are right now. You are in the school desk learning. Are you going to grow? It's up to you. I strongly believe some of you are going to grow, but that creates another problem. Can you, by the learning and growth, can you identify the aspects from that learning and growth process which you can implement in your internal process to bring more value to your customers? Because without improving the internal process, learning and growth doesn't mean anything. But again, the motivations come from the financial perspective. If you want to see improvement there, now you have to go back to the chain. So from see who is the customer, why he's not happy, improve internal process to create more value to the customer. How can you improve the internal? By learning it. And you always have to ask questions. If there's something that you don't like from a financial perspective, of course. So the balance scorecard have a financial and non-financial measures. So why do we need those non-financial measures? Because the financial measures are lack indicator. Summarize the results of the past action. If you want to change something in the future, you have to focus on the non-financial. Again, we're using the financial only and only to see where we are. Is there something that we like and we don't like? And if you want to change something in the financial, we have to start working on the non-financial measures. Also, top managers are originally responsible for financial performance measures, not the lower managers. So the non-financial measurements are more likely to be understood and controlled of the lower level management. Now, How many balance scorecards we should have? You can create as many as you want. You have to definitely you have to have a balance scorecard for the entire organization. How the organization brings the value to its customers. Then you can have a balance scorecard for every single employee. What value that employee brings to the company, which increase the customer satisfaction. The personal balance scorecard should be measured, should have measures that can be influenced by the individual who is evaluated and support the measures of the overall balance scorecard. So everything has to be prepared in relation to one each other. And the things that drive the balance scorecard will be the strategy of the company, mission, and vision. Now, the balance scorecard should have measures which are in the relationship of cause and effect. If I do this, what's going to happen? If I do this, what's going to happen? If I improve one thing, what's going to happen with the other? Now, the incentive competitions, when we have, if you want to compensate the individuals, the, one of the best way to do that is by using the balance scorecard. Which, what that means to you is, if you want to have a raise increase, or if you want to ask for the raise increase in your company that you're currently working, use the balance scorecard. But how you should use it? Very simple. Instead of going and asking your manager for the raise, increasing your rate, start from the bottom. First, tell them what you have learned, what you have implemented, what you grow. Then tell them what you improve in yourself, in your skills, in your attitude, in your behavior. Then focus how what you learn and what you improve in yourself affect the customers. And if you do that, the logical conclusion will be that you deserve raise. So don't start with asking money in the first place. Tell them what you did and how you did it to create more value for your customer, which in fact is your employer. And if you do that, I can guarantee you that you're going to get a raise. So, example here will be this company, Jaguar, which have the financial, customer, business, and learning to grow. Financial, they focus on the profit, contribution per car. Now, in order to get the profit, they need to sell cars. So for that reason, they focus on the number of the cars sold. And was the customer satisfaction with the options available, because if you have more options of the cars, that's going to increase the profit of the company. Now, in order to provide more options for the customers, in the internal business process, we have to learn how to increase the options available. And we have to reduce the time to install those options. It means be more efficient. How are we going to achieve that? By teaching our employees about the new options in the car and how to improve the process in order to save time and to increase the contribution per car by reducing the time, because reducing the time means the reduced cost of labor. Okay, so let's see how it works. If we increase the skills of our employees, that's gonna help us to increase the options. And if we increase the skills of our employees, that's gonna reduce the time to install those options. But if you provide more options for the customers, that's gonna increase the customer satisfaction. Once we increase the customer satisfaction, we can sell more cars. And since we reduce already the cost by being more efficient and reducing the time of installation, that means our contribution per car is going to increase, which is going to hit us in our profit. Now we can enjoy the profit. Believe me, nothing's going to happen in your bank account if you don't think what you can improve in order to make your customers happy. Transfer pricing. On the transfer pricing, I'm going to spend time after chapter 12. I want to connect those one because the transfer pricing is related to the decision making. At this point, I'm going to stop with this chapter. And that will be conclusion of the chapter 11.